What's up, everybody, and welcome to the show today. Today, we're going to be diving in. We're going to be talking a little bit more about consumer credit scores, which is a little bit different. Usually, I do a lot of webinars, a lot of presentations, a lot of podcasts talking about business credit scores. But look, it's undeniable that your personal credit scores are absolutely important to you as you build the business. There are times you're going to need to use your personal credit, and understanding how your FICO scores work, most importantly, how you can control your FICO score, is a really big deal, because that's what empowers you to be able to get the interest rates that you want on personal loans, even business loans, and other things as well. So today we're going to be talking about what business owners should know about your FICO scores. We're also going to be talking about how you can easily control these 5 different aspects of your FICO score. We're even going to be talking a little bit more about VantageScore, the credit bureau scoring model, and your FICO SBS, or your FICO business credit score. So we have a lot to go over and not a lot of time to do it. So let's jump in. For those of you that don't know me, my name is Ty Crandall. I'm actually the CEO of Credit Suite, and you can get more information on business credit building if you'd like at our website, creditsuite.com/EIN. That's Credit Suite, which is spelled SUITE.com/EIN. We have a cool guide there on building your business credit. So far, if you don't know much about me, I probably, oversaw maybe 10,000 plus customers now, helping them build business credit, as well as probably double that of followers that follow us on social media and do it as well. So if you want more information, feel free to check us out. There's a great guide. If you have any questions on business credit building or anything we cover here, feel free to reach out to us as well. info@creditsuite.com, 877-600-2487. So who is FICO? Well, FICO is a business analytics actual software company. Okay, so they're based in San Jose, California, and FICO was founded by 2 guys, Bill Fair and Earl Isaac, back in 1956. So the FICO scores become really the main credit score used to determine consumer risk. And I was actually just at an event called the Credit Bootcamp not too long ago, a couple weeks ago, and John Alzheimer, who's one of the foremost experts on personal credit scoring, was there. And it was interesting because we were having a conversation. He was talking about, how recent FICO has really been used, which is what we'll dive into during this webinar. I mean, believe it or not, it really hasn't even become really used, or we've had access for really less than 20 years, even though it was created back in 1956. So William Fair was one of the original founders and was an engineer by trade. And then Earl Isaac was another founder, and he was a mathematician by trade. So the two met while working at the Stanford Research Institute in Menlo Park, California. And in 1958, FICO pitched their first credit risk analysis system to 50 different American lenders. So FICO went public in 1986 and is traded on the New York Stock Exchange under the ticker symbol FICO. And the company debuted its first general purpose FICO score in 1989. So again, if you think about this, man, that's less than 30 years ago. They actually debuted the first general purpose FICO score. So scores are based on credit reports that range from 300 up to 850 is the actual score range. And lenders use these scores to gauge a potential borrower's credit worthiness. They're trying to determine whether or not they should give you credit, they should give you money, and if so, how much credit or money should ultimately they give you. Fannie Mae and Freddie Mac first began using FICO scores to help determine which Americans could qualify for mortgages back in 1995. And this, as often happens, this is when things really became popular. This is when FICO started becoming very widespread, is when it was required to qualify for mortgages. And this is the same as the FICO SBS score, which we'll dive into later. It's become very popular now because just a number of years back, they actually mandated SBA as part of their loan approval requirement. So when SBA comes in, or when Fannie Mae or Freddie Mac come in and start using a particular credit score, then what happens is that's when it kind of goes viral per se. It becomes widespread, industry-wide as a standard. And again, this only happened in 1995. So if you think about it, that's about 20 years ago that FICO has really become the standard for credit scoring or gauging risk. So originally called Fair Isaac and Company, this name was changed to Fair Isaac Corporation in 2003, and the company rebranded again in 2009, and it's now called FICO. Again, pretty crazy. Up until whatever that is, 7 years ago, they were known as Fair Isaac Corporation. And then finally, I think they just gave up and said, look, everybody knows us as FICO because of our FICO score. So just 7 years ago, they actually took on the name FICO, making their name the same as the signature score they offer. So again, they're originally based in San Rafael, California. They moved to Minneapolis in 2004. Then they moved back to San Jose in 2013. So again, they're back kind of where they started. They have kind of an interesting history of going back and forth between the locations they've been at. Now, to grow as big as they are today, FICO's acquired a lot of smaller companies along the way. And this is what happens. It's the same with the credit bureaus. A lot of people don't realize that, it was a number of years ago where credit bureaus there weren't three big credit bureaus. What happened was there were regional credit bureaus. So there was a lot of credit bureaus in a particular region. And then as TransUnion, Equifax, and Experian got bigger in the consumer world, they started buying up and acquiring all of these other smaller credit companies to make them as big as they are. Well, FICO's no different. FICO's purchased, and I'm not going to go through all of these and read all these to you, but I will just tell you that there's a lot of acquisitions of companies that deal with analytics, that deal with some type of risk scoring that they've now they've now acquired. So these are some of the companies, from Dynamark to Risk Management, to Diversified Healthcare Services, to Surratt, to London Bridge Software. All these have been acquired along the years, and they're using their technology to basically improve the basic of FICO. So to grow as big as they are today, again, there's even more small companies here that they purchased. So here's some more of their purchases all the way up until about a couple years ago, Braun Consulting, Adeptra, and so on and so on. So the bottom line is they've got as big as they are by other companies coming in, developing their own technology, and then FICO acquiring those companies, adapting their technology into their product and services. So FICO offers a lot of different products and services: customer acquisition analytics, debt management and collection analytics, fraud and security analytics, risk analytics scoring, customer decision-making, and analytic data solutions. So, it's just like the credit bureaus. The credit bureaus offer, like Dun & Bradstreet. Dun & Bradstreet offers a lot of different products that you may not even think about. You may just think of Dun & Bradstreet because of their actual credit score. But the reality is they deal with risk management. So they actually offer a lot of products and services based around risk management. They also offer a lot of list access and marketing resources, those type of things as well. Now, again, in the beginning, I always like to go through a handful of slides kind of that talk a little bit about the history before we get to the meat of what FICO score is. So don't worry if you're not really into the history and how we got to this part. No big deal, because now we're going to take a jump to talk a little bit more about the actual FICO score itself. So FICO score is the most widely used credit score in the world today. FICO score is a mathematical model that's used to depict a consumer's risk of going 90 days late on an account within the next 24 months. This is exactly what your FICO score is. So your FICO score basically tells a lender your risk of going 3 months late on an account they give you within the next 24 months. Now, as lenders use the FICO score to help them make billions of credit decisions every single year, and FICO calculates the FICO score based solely on information on your consumer credit reports maintained at the credit reporting agency. So that's it. FICO score doesn't use anything that's not on your credit report. It doesn't use your ethnicity. It doesn't use any other factor, your religion, any of the things that are not on your credit report. And a lot of those things are not allowed to be on your credit report per the Fair Credit Reporting Act. FICO does not use at all to calculate its decision. It's only based solely on the information in your credit report. Excuse me, I have to clear my throat, so apologize if you just heard me cough there. So FICO calculates only the score based on the information that's on your consumer credit report. And again, those scores range from 300 to 850. So that FICO score is calculated by a mathematical equation that evaluates a lot of different types of information from your credit report at each credit reporting agency. Okay. Then by comparing this information to patterns in hundreds of thousands of past credit reports, actually it's millions of past credit reports, FICO score estimates your level of future credit risk. So FICO is basically telling lenders, credit issuers, look, this person has this much risk based on current, based on how they spend, based on how their utilization is, based on the actual payments they make. As we've looked back through millions of reports, this is what we determine the risk is of them going 90 days late in the next 12, 24 months. So you have 3 FICO credit scores, one for each credit bureau. So Equifax, TransUnion, and Experian have all purchased their own independent credit scoring model from FICO. And then each score is based on information the credit bureau has on file about you. And that score from each credit reporting agency is considered only the data in your credit reports at that agency. So for example, if you have 10 accounts that report to Equifax and 5 accounts that report to Experian, well, then your Experian and your Equifax credit scores are going to be completely different because they have different information. And a lot of people ask that, well, why are my credit scores different between the 3 reporting agencies? Well, that's why. It's different because each reporting agency has different information about you and is reporting a different amount of accounts. Well, why is that? Because creditors choose to report to who they want to report to. Some creditors don't report to any reporting agency. Some report to only Equifax. Some report to TransUnion and Experian. Some report to all 3. But if you look at your credit report, you'll often see that you have accounts that may not report with all 3 credit reporting agencies. So your scores are different because they have different accounts listed on each report, and because again, they all have their own FICO credit score they purchased. They're very similar, but they're not exactly the same, which is why your scores are different. So your credit score may be different each of the main reporting agencies, and if your current scores for the credit reporting agencies are different, again, it's because the information that they have on file is different. So if your information is identical at all 3 credit reporting agencies, well, then each FICO score would be pretty close to the same. Okay, so for your FICO score to be calculated, your credit report with the Bureau has to have enough information and enough recent information on which to actually base your score. So generally that means you have to have at least one account that has been open for 6 months or longer, and at least one account that's been reported to the bureaus within the last 6 months. So let's look at this and compare this to business credit. What's beautiful about business credit is that you can get a score the minute you get credit, and that credit reports to the business credit reporting agencies. So if with business credit, if you come in and get a Uline account and a Quill account, and you get a Monopolize Your Marketplace, let's say you have 4 accounts, and you pay those as agreed, well, those report to Dun & Bradstreet, and you instantly get a good score. You could get a score in 30 days or 60 days as soon as those accounts get reported. FICO's different. FICO won't even give you a score unless you've had credit for at least 6 months. So if you got 20 new accounts today, paid them all as agreed, FICO would not even give you a score if you had no previous credit until you've had that credit for 6 months. And then you have to continue to use some credit in order for them to continue to give you a score. So if you shut off all your credit cards, your home loan, if you shut off your car, all those things, if FICO had no credit at all, and had no accounts within the last 6 months, well, then they're not able to generate a reliable score. So the only way they can generate a reliable score is if you have had credit for longer than 6 months, and if you've had credit reported within the last 6 months. So there's a lot of different types of scores you should be aware of. Okay, and there's a lot of these different models or scores that exist out there today. So credit scores are ones you can pull yourself. So maybe you have credit monitoring like Identity IQ, for example, and you pull your own credit score. Okay, maybe you go to apply for a mortgage. Maybe you go to apply for a car loan. So all of these different places would generate different credit scores. Okay, there's actually over 16, or now there could be even over 27 of these kind of scorecards that exist today with FICO alone. So what is a scorecard? Well, we'll talk about it here as we get deeper into these slides, but scorecards are ultimately used that are industry specific. So mortgage industry has its own scorecard, its own variant of the FICO score that's different from an auto score, for example. So each of these scorecards are going to reflect completely different credit scores. This is why you could go in to get a car loan and end up getting a completely different credit score than if you went to go in and get a home loan. Like I will go in, if I went in today to buy a car and they said, Ty, your credit score is 720, and I went to apply for a mortgage, that mortgage company is not going to tell me my score is 720. They're going to tell me it's something completely different. They could say it's 680. They could say it's 760. But even on the same day, I would get a completely different credit score if I pulled my credit online, went and applied for a car, went and applied for a home. All 3 of those scores would be different because they're all using different scorecards. So these scorecards are designed to help particular industries like the mortgage industry, like the auto industry, like the credit card industry, better gauge your credit risk. So the mortgage industry, for example, is more concerned with your past mortgage history than anything else. I mean, this makes perfect sense, right? So you go in to apply for a home loan, and Fannie Mae and Freddie Mac's is okay. What do we care most about on this person's credit report? Well, obviously, they care most about how you've paid previous home loans. The same thing with your auto score. So if you go in to get a car loan, well, guess what they care about most? Your past auto history. Do they care about your mortgage history? Do they care about credit cards? Yes. But if you are more inclined to pay your car on time, then that means more to them than if you pay a credit card on time or not. Same with a home loan. If you go to apply for a home loan, the lender issuing you the home loan cares more about what you've done historically in the past to pay your home loans on time than they do care about how you pay your credit card on time. So what happens is they weigh that home loan history heavier into the total score calculation than other accounts. This is why scorecards exist. This is why when you apply for a home, when you apply for a car loan, the scores are different, because what they're doing is they're saying, okay, instead of weighting a car at X into the score, we're going to weigh the home loan much, much heavier, meaning a lot of the scores they pull weight your past mortgage history much more into the equation than anything else. So an example of this in the business credit world is Dun & Bradstreet's Paydex score. So the Paydex score is based solely on how you pay your bills. You pay your bills on time, you get an 80 score. But it weighs the higher limit accounts heavier into the score than the lower limit accounts. That means if you were ever going to go late on a business credit account that reports to Dun & Bradstreet, you want to go late on the lowest limit account you have, because the highest limit account you have that reports calculates the most into the overall credit score. Same thing here in the consumer world. If they're pulling a mortgage scorecard or an auto scorecard, then they're weighing your auto history, your mortgage history heavier into that score calculation than anything else. So a consumer's credit score might be 660. Maybe you go pull your credit through a credit monitoring service and you pull a 660 credit score. But then when you apply for a mortgage, your score could be a lot lower because you had past negative information on your mortgage. Maybe you had late payments on a mortgage in the past. So you go and you say, okay, identity IQ, what's my consumer credit score? I'm going to apply for a home loan. Okay, it's awesome. Great. I got a 660 score. Fantastic. I should be able to get a pretty good rate. I should be able to get approved. No problem. And then you go in to apply for a mortgage and they go, sir, listen, your score is 610. You're like, well, what are you talking about? I just pulled my score today with 660. Well, why is it 610? Well, it's 610 because they looked at your credit report and they see that there's 3 old late payments on your mortgage, and that weighs heavier, that mortgage history, into your credit score. So because you had late pays and negative information on a past mortgage account, your mortgage score would be lower than what you'd actually see with your consumer credit score you may pull with an actual credit monitoring service. Now, it could be the opposite too. It could be higher. So let's say you pull your credit score and you say, okay, it's 660. Perfect. Let's go apply for a home loan. And then you go in and you go, okay, I want to apply for a home loan. And they go, okay, great, sir. Your credit score is 690. You're like, boom, that's awesome. Well, why is it 690 when you pulled a 660? Because you have 5 years of past perfectly paid as agreed mortgage history. Okay, so again, because this history is weighted heavier, then your scorecards will be different. If you have bad payments on a mortgage or bad payments on a car loan, well, then your car score, your mortgage score would be lower. If you have really good auto past history, your auto score would be higher. If you have good past or bad past auto history, your scores would be lower. So for example, if you had late payments on a car loan in the past, but perfect mortgage history, well, then your mortgage score would be much higher than your auto score because you paid your mortgages in the past as agreed. You didn't pay your auto accounts as agreed. Okay, so this is how scorecards work. Okay, now a credit score that a consumer pulls themselves is not going to be the same, again, as the mortgage industry option score. You just learned something that most mortgage brokers I would guarantee you that 9.9 out of 10 mortgage brokers or bankers you ever meet that you ask them what a mortgage industry option score is will tell you they have no clue. Okay, they pull tens of thousands of credit reports that makes lending decisions, and most of them don't even know the actual scores they use. And this is exactly the name of that score model. It's called the mortgage industry option score. Okay, and there's also an auto industry option score. And just knowing that, you know more than 99.9% of people that will ever pull your credit to give you an auto loan or a home loan, because they don't even know about these different scorecards in a lot of cases, let alone the name. So the mortgage score won't be the same as the auto score, again, because they auto score, the auto industry option is weighting your auto history or heavier into the score than mortgage history. These different scorecards are designed to help specific industries better determine risk. It makes perfect sense. So due to there being so many industries that offer credit, there are also just as many credit scores available. And so this is something I get asked a lot. Look, why is my credit score so different? Why do I go into a bank and pull a score, pull a different score online, pull a different score when I apply for a credit card, pull a different score when I get a home loan or not? Here's why. Because you could literally go to on your bank, and your bank gives you your credit score, and you're like, my credit score is 650, and then you apply with a credit card, and then all of a sudden the same bank gives you a score of 670. It's because they're using a different scorecard to actually determine your approval for an actual credit card. Okay, so plus different scores are offered by different companies, creating even more credit scores. So we've just been talking about FICO and FICO's different scorecards. But keep in mind, FICO's not the only company out there that provides credit scores. Yes, they are the biggest provider, but not the only provider. So the credit bureaus have actually came up with their own score called VantageScore, which you'll often see out there. And credit monitoring services owned by the credit bureaus, which there are quite a few, use VantageScore, right? So they're using their own score, which is known as VantageScore. So this is interesting, and this is a topic for another day, but let me kind of give you some insight into the credit system. It's actually quite brilliant on the credit bureau's part and quite negative for us. So we've all heard that identity theft is on the rise, right? Well, the reality is that the majority of identity theft that happens isn't anybody really stealing your identity. What happens is it's the credit bureaus pulling somebody else's information and populating it on your report, thinking it's your information. Then all of a sudden you go, oh my gosh, somebody's stealing my identity. And then you take steps to correct that. One of the steps you usually take is to sign up for credit monitoring. So what's happened is the credit bureaus have literally created a multi-billion-dollar industry because identity theft is on the rise, in large part due to their mistake of putting things on your credit report that shouldn't be there. And then you go pay for credit monitoring, and guess who you're paying? You're paying the credit bureaus, right? Because the credit bureaus are the ones that now own a lot of the credit monitoring companies. So literally, when you have bad things on your credit report, things that shouldn't be there, they're making even more money because they own the credit monitoring companies in a lot of cases, and they also now own the credit score. They don't want to pay FICO for those scores anymore. They wanted to create their own. So they created their own to try to compete with FICO, known as VantageScore. Okay, now VantageScore was unveiled by the bureaus on March of 14th of 2006, and all three main reporting agencies use the same formula to calculate VantageScore. So VantageScore has scores as high as 990. While FICO scores can be as high as 850. And I'm going to show you this. I'm going to show you how FICO breaks down. I'll show you how Vantage breaks down. It's a big difference. You need to know this. Because if you go to a credit monitoring service and you're like, boom, baby, I got an 850 credit score. Well, is it FICO or Vantage? Because if it's an 850 Vantage score, that's actually good credit, but it's not great credit. Okay, if you had a 720 credit score with Vantage, that's not good. That's below average. So it's a big difference because VantageScore ranges as high as 990, whereas FICO goes as high as 850. So even though a 700 credit score reflects a good credit score with FICO, a $700 Vantage score is actually a bad score. It's actually below average. So here are the Vantage risk levels, and I'm just going to go ahead and show them to you all at once. So A credit or good credit is 900 to 990. B credit is 800 to 899. C credit is 700 to 799. So here we are. So in the FICO world, A credit's like 700, like 680 to 700 is what they consider to be good credit. Well, that's a C credit in the VantageScore world. D is 600 to 699. An average credit score in the FICO world is about 650. Well, in VantageScore, that's D. That's bad credit. And F is a 501 to 599. So very different because it goes as high as 990 versus FICO that goes as high as 850. So obviously, the scores go up to 990 versus FICO that goes up to 850. And obviously, that's created big issues for lenders. Okay, so one of the main reasons VantageScore isn't widely used is because of this. You know, a VantageScore, and I don't know if they could have done this with FICO. I don't know if what parts of FICO scores they have trademarked. But if Vantage, if the bureaus would have just had their score range as high as 850, like FICO, they might have got it more widely accepted than they did. But when they went to 990 and all of a sudden they started telling people, okay, 700 credit is now C credit, lenders who've been underwriting loans for decades and decades based on this information are like, no, it's not. 700 is good credit. It's not C credit. And so this is part of the reason that they've had a really hard time getting Vantage accepted more widely with lenders as what they have. So the bureaus have changed their score range with Vantage 3.0, which was actually released in 2013. And with the new Vantage scores, they only go as high as 850. So now what they're doing is they've come in and they started to mimic more of what we see with the FICO score. So again, why does this matter? Because, look, you when you go to apply for a Fannie Mae and a Freddie Mac FICO score, do you know that you are actually still pulling their old model that was developed in the 90s? So even though FICO's updated their model, a lot of these lenders and underwriting systems don't want to keep updating. So a lot of them are using outdated credit scores. So this is why you need to know this, because it's very possible that you'll apply for credit with a credit issuer or lender, or even apply with an actual credit monitoring company for credit monitoring and see an old Vantage score that makes your score much higher than it is. So when you're getting credit monitoring, you should make sure you're getting a company with FICO scores. If you don't know, ask them. Just call them and ask them. Look on their website. Are they offering FICO or Vantage? If they're offering Vantage, stay away from it, because that's not what most lenders use. So how are your FICO scores calculated? Well, actually, this is the Vantage score, since we're on that topic. So here's your Vantage and here's your FICO. So with Vantage score, 32% of your overall score is payment history. With FICO, 35% is. With Vantage, utilization accounts for 23% of your total score. And with FICO, actual utilization accounts for 30%, or amounts owed. With Vantage, balances owed is 15%. Depth of credit, or your credit mix, is 13%. How much recent credit or inquiries you had is 10%. How much available credit you have calculates 7% of your score, totaling 100% if we add all those together. FICO is a little bit more simple because it's only based on 5 factors, not 6. Payment history is the biggest factor, 35%. How you pay your bills. 30% is the amount you owe, your utilization. Length of credit history is 15%. Types of credit, or what's called your credit mix, is 10% of your score. New credit's 10%. So that gives you a pretty cool, probably one of the only side-by-side comparisons of Vantage versus FICO you may actually ever see. So Fair Isaac and VantageScore hold their credit scores very, very close, right? I mean, they keep the way that they calculate data as close of a formula as probably Coca-Cola's is for what their product actually is, or even your grandma's chocolate chip cookies. This isn't something they like to tell a lot of people exactly how it works. So it can be frustrating because you pull your credit report, you get denied, you see a score, and at the top of the report, you see something like too many revolving debt accounts. And you don't even know what that means. You're like, what does too many revolving debt accounts mean? And it's frustrating because they keep their cards so close to the chest with how their scores are calculated. But fortunately, they've issued a lot of public information on this so we can get a better dive into how these scores actually work. So payment history, and we looked at FICO and Vantage, this is the biggest factor. This is the top rated factor for both models because the lenders want to know a person's payment history, past and present. So this can actually be broken down into 3 categories. Recency, the last time a payment was made late. The more time that passes, the better. So we're taking a deep dive. If you've ever looked before, you've probably seen the pie chart of 35% of your credit scores, payment history, 30% utilization, yada, yada. I just kind of showed you a little bit about that. But now we're going to break it down even more. Payment history actually is broken down by the reporting agencies into 3 different aspects. One is recency. Okay, when's the last time you made a late payment? Meaning that if you have 2 accounts, one you just paid late and one you paid a late 5 years ago, the one you just paid late has much more of an adverse impact on the score than the one 5 years ago. Frequency, one late payment looks a heck of a lot better than a dozen, right? So how often have you been late? Were you just late once? Have you been late often? Okay, severity. A payment 30 days late is not as serious as one 120 days late. Take a drink of water, please. Excuse me. So Those are the three factors: the time to payment history. How recent is the late payment? How often are you late? How late are you? 30, 60, 90 days late. So that means if you're looking to control your score, obviously don't go late. But if you do go late, then, the older those late payments are, the better your score is. And don't go late very often, because that will hurt your score even more. And try to get your payment paid no later than 30 days later. Then it starts going into a 60-day or a 90-day or 120-day late by increments of 30. Collections, tax liens, foreclosures, repossessions, charge-offs, and bankruptcies are all credit score killers, right? Because a collection is the default. That's 120 days late. Tax liens, foreclosures, repos, charge-off, any of these is default. So all these indicate that you're more than 120 days late, which is why they're so severe to your score, because the severity is so significant. The frequency is significant because it showed you went 30 days late, then 60, then 90, then 120. And if they're recent, then all these together are just absolutely crush your score. So you can improve this aspect of your score by paying your bills on time. Also, the more accounts you have paid as agreed to offset the ones you don't have is also going to help your score. Man, when I used to own a credit company, I see this all the time. People would actually, this happened in the mortgage industry when I owned my mortgage company. Okay, people would come in and say, I'd say, how's your credit? They go, I think it's pretty good. Okay, great. They'd pull their score and the score was 520. And I say, well, what would make you think your credit's good? And they say, well, I went late. I had problems, obviously, as you can see on my report, a long time ago. And I haven't had any problems since. So what happens is a lot of people think they're going to go later default, and then they're just going to not do anything with their credit, and that their credit's going to get better. But the problem with that is that in order for you to offset the negative accounts you have to add positive accounts. If you don't add positive accounts, you can never have a positive score, because all they're going to have to go off of is your late payments. So one of the best things you could do to improve your credit is to add more positive accounts. The more positive accounts you have to offset the negative, the higher your scores will be. So if you do have late payments reporting on your report, add positive accounts, offset that, and make sure you have a lot of accounts that you continue to pay as agreed to offset the negative. I see this in the business credit scoring all of the time in our business credit scoring world. So on Periscope and Facebook Live, I'll often get in and pull people's credit reports that want me to pull their credit report. And I'll see 50 scores. I'll see 12 credit scores. I see really, really, really low credit scores. Okay. And as a result of that, we look at the score deep and we realize it's only because they had one account and then one account was paid bad. They paid it a little late. So because they only have one account and pay it late, or maybe it's new, the scores are low because there's not enough positive history. It's the same in the consumer world. You have to have good positive history to offset the negative to really have the best chance of having the best scores. So how much is owed? The score looks at the total amount owed on all accounts, as well as how much you owe on different types of accounts, mortgage, auto, etc. Using a higher percentage of the limits will worry lenders and hurt your actual credit scores. So people who max out their revolving credit card limits have a much greater risk of default statistically than those people that don't. Okay, so utilization, when it comes to revolving debt credit cards, the formula looks at the difference between the high limit, the limit of your credit card, and the balance you actually have. So for example, let's say you have, or your customer has a MasterCard with a credit limit of $10,000 and you've spent $2,000 of that. Well, that's a 20% utilization. The lower the ratio, the higher the credit score. So 20% is okay. So how does this work? So I'm going to kind of break it down like this. If you have more than 30% you owe on an account versus the limit, it will hurt your scores. So if you have a credit card with a limit of $1,000 and you owe more than $300 of that $1,000, you are damaging your credit score. Anything above 30%. How low should your utilization go? Less than 10%, as low as you can go and still use the card. Remember, 35% of your score is payment history. So you want to make sure that you use your credit card and pay the bill as agreed. That's what helps your scores get better. But you want to keep a really low balance on that compared to your limit. Definitely under 10%. Over 30% will hurt your score. Under 10% is best. And preferably 1-2% is where you want to keep it. You want to keep some kind of balance on your credit card to show that you've got a balance, that you're paying your bills as agreed, but not high enough to show that you're overutilizing that actual account. Okay. If you're looking for a quick credit score boost, pay down any accounts that you actually can. Okay, so if you're looking for a credit score boost, then pay down your utilization. Now, it's important to note this takes in all different kinds of accounts here, right? So it takes into account car loans and mortgages. So when you first get a mortgage or you first get a car loan, your scores will be lower. They will go down because, again, you just got a car loan for $20,000 and you owe 20. So it'll always lower your score, especially for the course of a year. But credit cards, man, credit cards are beautiful because you can add available credit to your credit reports and really see your scores go up. You could pay down credit cards and really see your scores go up. I've seen people's scores drop 80 or 100 points just because they have a few $100s more on a credit card than they should because they're overutilizing that account much more than they should be because the limit's not high enough. So if you want the fastest hack to improve your score, pay down the limits on your actual credit scores, okay? And if you do so, that's one of the easiest things you could do to improve your scores quickly. So again, with FICO, 30% of your scores based on utilization, 35% is payment history. So utilization is the second highest weight into your overall score. That means by overutilizing your accounts, you can literally almost damage your scores as much as if you paid those accounts late every month. Not opinion, just math, right? 35% is payment history, 30% is utilization. So you've got to make sure you keep the utilization low because it's such a massive factor into your overall score. So anything over 30% of your limit being used will lower your actual scores we talked about. And adding credit cards to your report with high limits can significantly raise your credit scores, sometimes as much as 100 points or more. So when I own my consumer credit company, this is one thing, the easiest things we did was we went to companies and there were companies out there that were jewelry cards. There still are some out there. Okay, and if you go to info@creditsuite.com and email us, we can get you access to at least one of those type of accounts that still exist today. So these accounts, you can only buy $5,000 worth of jewelry in their store, but they'll give you a $5,000 limit account with no balance on it. So the minute that account reports on your credit reports, your scores will skyrocket. And we used to do this a lot to help people in the mortgage industry. We would take somebody from a 580 to a 620 so they could qualify for a home loan just by adding a high limit positive account like this to your credit report. So you can significantly raise your scores by actually coming in. And you know what I'll do is I'll come back to this video later this week, and I'll even put a link in the video so you don't have to email, a link where you can come in and get one of those industry-specific high-limit accounts because they really, really are pretty cool to boost your score. They do have a cost, and I haven't looked at it in quite some time. I don't remember how much it was. It used to be like $50 or less to set up the account, but the minute that $5,000 account would hit the credit report, we would see big improvements to the score. So in the actual description of this video, I will come back, and by Friday, I will have that added in, so you'll have a link where you can get one of those type of accounts. But even if you don't get one of those type of accounts, consider a regular credit card, consider a secured credit card. Adding something with a lot of available credit on it will really boost your score. Just make sure that you don't overutilize that account. So one more important tidbit is closed accounts do not help and can hurt if there's a balance remaining. So a long perpetuated myth has been to close accounts that are not in use, but this will actually hurt your credit scores in a couple different ways. As you know, overall an individual account utilization plays a major role in credit score. So the bottom line is if you close accounts, you lose access to that available credit, which hurts your scores, as well as you lose access to the payment history, amongst many other things. So length of credit history or the depth of your credit. This is less important than the previous factor. Remember, with FICO, it's 15% of your score. It's half as important as what your utilization is. It consists the age of the oldest account and the average age of all your accounts. Very big deal, something most people just do not know. So length of credit history is depicted based on the age of the oldest account you have in your credit report and the average age of all of your overall accounts. It's possible to have a good score with short history, but typically the longer the better. So John Alzheimer, who I mentioned earlier, one of the foremost experts on credit scoring, he actually had a blog post about this. It was really interesting. And what he said is he did a survey of all the people he could find, or not all, but a group of people that all had 830 to 850 credit scores, the perfect credit score. And what he found was that all of them, 100% of them, had a credit card that was open for more than 12 years. So the longer the credit score you have, the longer credit history you have, the higher your score is. To get to an 820, 830, 850, the highest you can get, you typically need to have accounts open 10 to 15 years. Again, in the people he surveyed, which was 5 or 10, none of them had a credit card open less than 12 years. All of them had at least one credit card open for 12 years or longer. So young people, students, and others can still have high credit scores as long as the other factors are positive, because remember, this is only 15% of the score. But the bottom line is, the longer that you have credit, the more you responsibly manage your credit, the higher your scores will get, which is why you pretty much have to have longevity on your credit report before you can ever get to an 820, 850 type credit score. So FICO, again, this is the third largest aspect of the score, because 15% of your credit score is actually based on length of credit history, while 30% is utilization. So if a person's new to credit, then there's little they can do to improve this aspect of the score. No newly added accounts can be backdated. You can't go get credit from a buddy of yours that offers it and have him backdate the reports. It just can't be done. Now, you can get added as an authorized user to a family member's account that's been in long standing, and that can improve this aspect of your score. It's the only thing I've ever found to improve this aspect of your credit score. You go to mom, dad, brother, sister, whoever it may be. They have a credit card that's been open for 12 years. You have them add you as an authorized user, meaning if they don't physically give you the credit card, you can't really use it, but it still reports on your credit report. And then all of a sudden you add a 10-year or 12-year account to your credit report. That actually will help your credit score. It's the only thing you can really do to improve this aspect of your score. So average age of accounts is another important reason to keep all your accounts open. If you have multiple accounts that you have had for some time but don't use, then you're still benefiting from the average age, even if you're not using those accounts. Also, make sure you use each of your accounts at least once every 6 months, and now you know why, right? Because in order for FICO to really calculate that in, they need to see that you're using that account within a 6-month time period. So at least try to make sure that you're using that once every 6 months, even if it's credit cards that you rarely use. So credit issuers must reserve the money offered in credit limits for their clients' use, so they don't like having accounts sitting dormant that are not making the money. And this is another common question I get is, why do credit card companies close the actual account? Why do credit card companies actually close an account that you're not using? Well, because they only given so much credit to issue. And if they're issuing the credit to people and then people are not using the credit, well, then they need to retract that credit so they have more people to lend it to. We saw this in the huge, big time in the recession in 2007, 2009 timeframe, right? So what happened was all these people that had $50,000, $100,000 limit accounts, all of a sudden, even though they never paid late, the credit issuers started lowering their limits because the credit issuers needed more access to credit to be able to lend. So they took it from the people that weren't using it. So if an account sits dormant long enough, that's exactly what they're going to do. They're going to cancel the account or reduce the limit on the account. And additionally, credit reporting agency will calculate an account as inactive if it's been active for 6 months or less. So these are all reasons you want to use and make sure that you're using an actual credit report every 6 months, because if you don't do this, then what happens is it will just sit dormant. Okay, so that's another reason you want to make sure you have accounts and you continue to use them. So new credit, recent credit. New credit is not always a bad thing. However, opening new accounts can hurt your credit score, particularly if a consumer applies for lots of different credit in a short period of time. Then what happens is that can adversely affect your credit, because this score factors in the following: how many accounts you've applied for recently, how many new accounts you've opened, okay, how much time has passed since you applied for new credit, how much time has passed since you opened an actual account. Okay, so all these are factored into what is called length of credit history, which accounts for 10% of your overall FICO score. So the model looks for rate shopping, but it does take this into account. So if you're getting a mortgage, if you're getting a car loan, let's say you go to apply with the mortgage broker sends it to 3 lenders. 3 lenders put inquiries on your credit report. This is most common used in the actual auto industry, right? So you go to shop for an auto loan, that auto lender then sends that out to, 5 different, sorry about that. It sends them to 5 different lenders as a result. And then all of a sudden you've got a bunch of different inquiries on your actual credit report, okay? So when this happens, these only actually calculate in an account for one inquiry. Okay, so auto dealers, for example, are notorious for running 3 to 15 different credit reports because they're sending them to different lenders. And we used to call this shotgunning the credit. They would just send the credit to a bunch of different lenders to get a bunch of different what are called rate calls. So locally, to compensate for this, FICO score calculates multiple auto and mortgage inquiries in a 30-day time period as just one inquiry into your score. So when you look at your total overall credit score and you say, oh my gosh, these guys pulled my credit like a ton of different times, well, don't worry, because that only calculates as one score into your actual FICO score, because these groupings of auto and mortgage industry specific inquiries only count as one when calculated in FICO. You'll still see multiple inquiries on the report, but they'll only calculate into your FICO score as one. So the specific calculation for cutoff dates and types is confusing. We'll go over that in detail in a little bit as we get a little bit further. So for most people, a credit inquiry really won't have any kind of impact on your score. Another common question I get, Ty, how much will one inquiry lower my score? Well, no, nothing. It won't. There is no account like one inquiry or two inquiries will lower your score. That's not how it works. How it works is that groupings of inquiries will adversely affect your score. If you go to apply for 5 credit cards, yep, that's going to lower your credit score. Applying for one may have no adverse impact to your score, may not even drop a point. However, inquiries can have a greater impact if you have a few accounts or short credit history. So if you don't have a lot of credit, and then you go to try to apply for credit 3 times, 4 times, that can have an even more adverse effect to your score. So large numbers of inquiries also mean greater risk, which is why your scores will go down. And according to myfico.com, people with 6 inquiries or more on their credit reports are 8 times more likely to declare bankruptcy than people with no inquiries on their credit report. So again, this is the kind of data that FICO uses. Now, they're not using it from, well, myfico.com is actually representative of what they found. So in their studies, they said, hey, look, what we found is that people with 6 inquiries are 8 times more likely to declare bankruptcy. So that means if you go in and get 6 inquiries in the next month or 2 months, your credit scores are going to go down, because again, according to their analytics, people that have 6 inquiries are 8 times more likely to declare bankruptcy. Why is this? Well, for example, I've known people that have went into bankruptcy, and the last thing they do is go to get as much credit as they can, knowing they're going to file bankruptcy. Now, there's all kinds of regulations and restrictions that prevent that from happening, as there should be. But there's all kinds of crazy things people do as they're getting ready to go into bankruptcy and applying for a lot of credit. Or a lot of people try to save themselves for bankruptcy. So they go to try to get a bunch of new credit cards in a last-ditch attempt to try to afford to pay their bills. There's 100 different reasons behind this. But what I know is that per FICO, the analytics show that people are much more likely to default if they have a lot of recent inquiries. So types of credit you use, depth of credit. So we've talked about 4 factors of FICO so far, right? We've talked about payment history, 35%, utilization, 30%, length of credit history, 15% of your total score. Okay. Then we just talked about new creditor inquiries, which is 10%. The last factor of FICO is the type of credit you have, which is often referred to also as well as your actual credit mix. Okay. And I got a couple of different questions here that I'll just get to. And then if I have time in the end, I'm going to answer a couple other questions. Somebody says, what is your Better Business Bureau reference? Well, you can take a look on our website, creditsuite.com. At the top, there's a link that says credibility, and you can take a look at that. You'll see we're A-rated with the BBB. We've never had any lifetime complaints ever. And then we also have a 5-star Trustpilot rating and blah, blah, blah. But you can take a look at that. It'll give you a lot of that information. Somebody else asked, do they have to be a hard inquiry? Yes, they do. What's the difference between a hard and soft inquiry? Well, hard inquiry is pulled by a lender. It's when you give a lender or credit issuer your permission to pull your credit. That shows as a hard inquiry on your credit report. A soft inquiry would be one, for example, if you get your credit monitoring every month. If you use a service like Identity IQ, and I don't know why I keep saying Identity IQ, that's the company I use, but there's a lot of them out there. Well, then every month you get a new credit report. That's a soft inquiry. You can pull your credit every single month, and it will not show as an inquiry on your credit report. So yes, hard inquiries calculated into your score, ones pulled by lenders and credit issuers. Soft inquiries just pulled by you absolutely do not. Okay, so back to credit mix, the last factor of your FICO score. So FICO recommends you have a balance of both revolving debts like credit cards and installment loans like auto loans and mortgages. The preferred number of credit cards they say is 3, but I've heard this widely disputed. I've heard and talked to people that have, again, John Alzheimer, perfect example of an expert in this space, said I think he has 12 to 15 credit cards open. So it's okay to have a multitude of different credit cards you open throughout your life, okay? But you want to have at least 3 credit cards. 1 to 2 mortgages is a good credit mix, and more than 2 auto loans is too much. So preferably, FICO wants you to have 1 to 2 home loans on your credit, 1 to 2 car loans, 1 to 2 other kind of loans, which are often called signature loans, and at least 3 credit cards. If you have this, then you have the basis of what they consider to be a good credit mix. And again, installment loans also score better if you have 2 or less. So you just want to have basically 2 or less of any kind of loan, and then you want to have 3 or more actual credit cards to have the best credit mix. So types of credit you use, depth of credit. Now this is coming back kind of to VantageScore. Both models want you to have this healthy credit mix, but they are vague on what this means. They recommend you have a balance of both revolving and installment loans, okay? And we talked about the numbers here. Okay, so here again is how your FICO score breaks down. Now we've went through all the specifics. Let's actually look at this in summary, right? So basically, this is exactly how your FICO breaks down. 35% of your score is based on your actual payment history. Okay, 30% of your score is based on your utilization. 15% is based on the length of time you've had credit for. 10% of your credit score is based on new creditor inquiries, and 10% is credit mix. So we've not only talked about all 5 factors into your FICO score, we've also talked about exactly what you can do and tips on improving every single aspect. So now, even if you go back to this later on YouTube or actually listen to this on our podcast, then you'll know and be able to go back and reference the things you can do on each aspect of your score to improve each overall aspect of your score. So FICO's newest score model is known as FICO 9. This new score includes a lot of changes from previous FICO versions. One is that medical collections are no longer scored the same as regular collections. They're weighted much less. So one of the biggest problems people used to have with their credit scores, they had a bunch of medical collections. So FICO's finally figured this out, and they now weigh those less than other actual collections. Okay, FICO anticipates that a consumer with median credit score of 711 whose only negative collection issues medical will now see an increase of 25 points. So the bottom line is FICO says medical collections don't matter as much as regular collections, which is a big change on the recent score model. Other changes that they've actually come up with is a customer who doesn't have a lot of credit, known in the business as a thin file, to repay a prospective debt. So these types of people might not have a score in the past, but now they will. So they have a newer way of scoring people that have very little credit, where before they just wouldn't even give those people a score. Non-traditional credit, such as your residential rent history, can also be taken into consideration. This is huge, guys. This is big, big, big. It used to be that you could pay rent and it wouldn't calculate your score. Now there are companies, because FICO made this change, that will take your rent, will add your rent as a supplement to your credit report, and now your credit scores can benefit from your rent payments. This is huge. So a lot of you watching, a lot of you listening, this is something you need to know, because what happens is now you could take your rent history and you can look on Google and find a lot of the companies that have popped up that do this, and then add that rent history to your credit report, and it factored into your FICO score. Okay, so again, even if you have little to no credit history, now your rent can even give you a boost. So paid off and settled collections will be ignored with FICO 9. This is, again, huge, and let me tell you why. This is what used to happen. You had a collection account that was 5 years old, right? Then you would pay the collection. The collection company would call you. They'd offer you a settlement. You'd settle it, and you'd pay it. The collection company would update the account showing that you now have a zero balance. But because you took a 5-year-old account and made a payment, you just recently updated the date of last activity. So your scores would go down. You would pay off a collection account and your scores would go down because you would have taken a 5-year-old late payment and now made it a current date of last activity on a defaulted account. Well, FICO finally realized that this is a huge problem, and now paid off and settled collections are ignored. So if you paid off the collection, now it's not going to damage your score because you made the payment with FICO 09 like it used to in the older ones, which was a big deal. Under the previous FICO model, again, if you let the account go into collection, I just talked about that. Now, as long as it has a zero balance, it's ignored. Huge is paying off collections used to prolong how long it stayed on their credit report. So how do you rate? Well, this is FICO's rating. Remember we talked about Vantage? Excellent credit is considered to be 750 or higher. Good credit is considered to be 700 to 749. Okay. And then fair credit is 650 to 699, and poor credit is considered 600 to 649, and bad credit is considered below 599. Hey, for the record, I'm not judging you. I'm just telling you exactly how FICO rates the actual credit from good to bad. Okay, so pay your bills on time. What can you do? We're going to do this, then we're going to wrap up with talking about the FICO SPSS business score, and then you hopefully got a ton of info in the course of about an hour here. So what can you do to have the best score? Well, pay your bills on time. If you are going to be late, tell your creditor you're going to be late. If you go late one time, don't say, oh man, my credit's screwed. Call your credit issuer and ask them for forgiveness. A lot of credit issuers will forgive you if you've been late one or two times just by asking them. It's very important to know that. So it's worth you calling them and telling them you're going to go late, or asking them forgiveness. If you do, they will often allow you some leeway. Have lots of positive credit on your report. Make sure you're using at least every 6 months that credit, so that way you can actually come in and have a good payment history to offset the one or two maybe late payments that you maybe have. And don't forget to have that good credit mix of 2 mortgage loans or less, 2 car loans or less, 2 installment loans or less, and at least 3 credit cards. Have open credit cards, 3 or more preferably. You keep your balances very, very low as 0 as possible, but still use them so you get a good positive history, and keep the limits as high as possible. If you want one of the easiest ways to raise your scores, if you have balances on your credit cards now, call and ask your credit issuer to raise your scores, raise your limits. Okay, tell them you do not want to put an inquiry on your credit report. They often don't do that nowadays. They often use your payment history with them internally to determine this. So there's no hard inquiry. Make sure that you know that before you do. And then just by raising the limits often really, really radically raises your scores. If your credit profile is new, get added as an authorized user account to a family member's account. Or if you don't have a lot of long-standing credit, then get with a family member. Have them add you as an authorized user. That adds the length of credit history to your credit. It improves your utilization. It gives you good payment history. So if they have a good account, it's another makes sense thing to do to raise your score. Do not apply for too much credit at once. Remember, FICO doesn't like to see 5, 6 inquiries in a short period of time. Okay, so if you get a car, a home loan, don't worry. If they put multiple inquiries on their credit report within 30 days, it only counts as 1. But any other kind of account, you need to be cautious of how much new credit you're actually applying for. So now let's wrap up and talk a little bit more about FICO's SPSS, or their business credit score. So the FICO SPSS score is a measure of your small business's credit worthiness. The score is becoming very popular with lenders, and the score has also become widely used by SBA. I should say widely used, but SBA will not do a loan nowadays unless they pull your FICO SPSS score, which is why it's so important. It's based on both your personal and your business credit history, not just your business, as the main business credit scores do now. So we teach people how to build business credit that's not even taking into account the personal credit, which is fantastic. But as you grow your business and get to a point where you're qualifying for things like SBA loans, well, then you really need to focus on your business and your personal credit, because SBA pulls this SBA FICO, or this FICO SPSS, and FICO SPSS takes into account both business and personal credit. So scores reflect the likelihood of applicant paying their bills timely. Scores range from 0 to 300 with FICO SPSS. High scores mean you're lower risk, so you want to get a 300 if possible. So the higher score you have, the better. Personal and business credit history, as well as financial data, are all used into the overall credit score calculation. So many factors actually tie in to your FICO SPSS score: the owner or co-owner's personal credit, your business credit history, the age of your business, the years in business, the financial data, including your assets. So people often ask this about loans, and you have to keep in mind that your business credit report has all this information on it. It has your credit history. It says how long your business has been open. It has your assets. It has your revenue. It has your profits. All that stuff that you put out in the world is public information. So this is all put onto a credit report and is often used to actually calculate or determine whether you will be approved or denied. All these things are also taken into account to determine your FICO SPSS score: the cash flow of your business. How much revenue do you have versus profits? The last 12 months of your Paydex credit scores with D&B. liens you've had, judgments you've had, any other financial data that they have out there that's available actually all calculates into FICO SPSS. So it's a highly intelligent score because it automatically goes from one business bureau to another and whatever priority the credit issuer has to generate a score. So for example, if the credit issuer says take into account Dun & Bradstreet data first, Experian commercial second, Equifax commercial third, and consumer credit fourth, then that's exactly how it's calculated. It will go and pull all the information from D&B, from Experian, from Equifax, then consumer, and prioritize it based on the order of importance the credit issuer tells them, which is often what matters. So most importantly, business credit matters most with your FICO SPSS score, and consumer credit matters not as much. But if you don't have good business credit, then your consumer credit becomes a heavier factor into your FICO SPSS. So you want to make sure you have good business credit and personal credit. By having good business credit, then it will offset not as good personal credit with the way FICO SPSS is created. Okay, so again, if a lender says pull D&B first, that's exactly what they'll do. And if there's not enough information on your D&B report, well, then that's when they'll move to your Experian commercial report, and that's when they'll eventually move to your consumer report. So what happens with FICO SPSS is that if you don't have any business credit established and your consumer credit can't even be good enough to give you an acceptable score to get an SBA loan. You have to have it. That's why SBA says you have to have good business credit to get a loan with them, because they pull a FICO SPSS score. You need a 140 score to get approved. Well, if you have no business credit and good consumer credit, your score still wouldn't be a 140. It's still not high enough to get an SBA loan. So to have an SBA loan, you need to establish your business credit. That calculates heavier into FICO SPSS. And with that, and even average or good consumer credit, then you have a high enough score to get approved for an SBA loan as well. So that being said, hopefully you got a lot of good information out of today. Today, now you know what VantageScore is. You know what FICO score is. You know how each of them break down. You've seen them side-by-side comparison. We've talked about different scorecards. We've explained the difference between an auto industry option and a mortgage industry option. You know how your FICO SPSS score works. And most importantly, you know how to improve every aspect of your consumer credit score. So now you can actually take control and actually, I don't want to say manipulate, but manipulate in a good way, your own scores, control your own scores, which, as you know, are so important for getting both consumer loans and credit as well as business loans down the road as well. And don't forget, you can build a business credit profile that's completely separate from your consumer credit profile. We've got a great guide, creditsuite.com/EIN, that maps out the exact steps to do that. That way you could build a strong business credit profile and obtain high limit accounts at Visa, MasterCard, Amex, Staples, Lowe's, Home Depot, Amazon, that's completely separate from your personal credit, that doesn't report on your consumer credit reports, and that also it doesn't even require a personal credit report to be pulled in order to qualify. So, right, there's a lot of benefits of business credit, but those are some that you can build it independently of your personal credit, that your personal credit quality doesn't determine whether you will or won't be denied. So a lot of benefits. creditsuite.com/EIN to get a free guide on exactly how that works. So if you have any questions on anything we can do to help you, if you want a reference for somebody that can help you fix your personal credit, that's not us, but we know a lot of people in the space. If you need any help with business credit building or have any questions related to that, please let us know. 877-600-2487, 877-600-2487, info@creditsuite.com. And somebody else had asked, what is the most effective way of soliciting business credit improvement clients? Well, Harry, that depends on kind of what you do. And that's a topic probably for another webinar. But if you're talking about getting new customers that are interested in building business credit, there's a lot of cool different ways we do that as part of our training, which we do training webinars for our clients every Tuesday at 3 o'clock Eastern. We go over those type of things, but it's the same way you market to get any customers, right? Facebook, Google, YouTube, Periscope. There's a lot of different ways you can market. So however you normally market now will probably be an effective way if you have the right tools to reach out and get business credit customers. But again, if you look at our YouTube channel, youtube.com/Credit Suite, then you'll find there that we've got some webinars even related to those type of topics as well. So I'm going to do one more question that I have to wrap up because I'm actually late for a 2 o'clock that I have going on right now. How popular FICO 9 is mortgage underwriting. Where does it get used? FICO 9 is used in a lot of different places, but unfortunately, the credit scoring used in the mortgage world is very antiquated because Fannie Mae and Freddie Mac really don't want to keep updating everything that their scores are based on and the underwriting systems they have. So they usually use an antiquated version of FICO that's not 8 or 9 in a lot of cases, but FICO 9 is widely accepted and used with a lot of the major lenders now, especially things like obtaining credit cards, car loans, etc. So I'm going to go ahead and wrap this up. Thank you very much, everybody, for taking the time to join us live on the webinar. Thank you very much, everybody, for taking the time to join us live on YouTube. And for all those people listening to this on our podcast, thank you so much for downloading. We will continue to put out a lot of great content to teach you as much as we can about business credit, and even throw in some stuff here to help you with consumer credit as well, so you can have good consumer scores, good business credit scores, and preferably, and most important to us in our world, have the ability to obtain business credit and to obtain business loans to start and grow. Thanks, everybody, very much. Hope you have a great day.